This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Due diligence reports are asked for primarily when one company is taking over another. The aggressor company basically wants to know, what am I buying? And of course what it is buying is the future. And anything which is in the financial statements of the target company is of course historical. And in fact the financial statements may be from almost a year ago, so 11, nearly 12 months might have gone by. So not only will the results of the target company maybe have changed dramatically over those 11 months, but also financial statements, even if they were absolutely up to date, leave an awful lot of really interesting and vital information out. So what we want to know is essentially fact-finding. I was once in a company which was subject to a non-due diligence investigation, and basically it came down to almost the investigating accountants saying, photocopy everything in the office and send it to us. We'll see in a moment the sort of areas they might be particularly interested in. The aggressive company, the aggressor company, the buying company, wants to know what the material risks are. It wants to know if there's anything particularly nasty it should be trying to discover, because since the last set of financial statements, who knows, an almighty legal case might have erupted, and the company's facing horrendous fines and damages and so on, which isn't really available in the publicly released information. Are the assumptions made by the buying company valid? So you're buying a target company in the hope that it's going to make profits, or in the hope that maybe it's going to develop components which you can use to make better products and so on. That maybe you're buying it because it's abroad. This is a quick way of getting into the foreign market. And you have a kind of assumption that it's a well-respected company in the foreign market. Is it in fact well-respected? Or is it a company which talks a good game and says it's well-respected, but actually it's not that highly regarded in the foreign market? Are the perceived business opportunities real? Is there really going to be an opportunity maybe for synergy, where we can use each other's sales lists, where we can maybe combine some departments and save some costs, and the like. If we don't know what these kind of synergies and advantages are, then we will have no idea really what to pay for this business, or even if it's worth paying for at all. And one of the big dangers in this takeover is, of course, the seller always knows more than the buyer. It's like buying a second-hand car. It's the seller who knows that the brake pads are low. It's the seller who knows that it doesn't start very well on a wet day, or whatever the problem is. And unless you ask the seller, they're under no particular obligation to tell you. Similarly with a company, it's the sellers who know more about the contracts they're in, their customers, how satisfied people are with them, how well their research and development is going, their technology is going, and they will talk it up, or the bad news, they might not even have to tell you that unless they are specifically asked about it. And there have been cases of companies being taken over, and when they've been taken over, the new owner discovering hardly anything worthwhile in them, that there'd been a considerable kind of amount of fraud or overstatement of profits going on, inducing them to pay a very high price for what was actually a very low value company. The sort of thing we're going to be interested in here, if you're buying a company, you'd be interested in the financial side, particularly the budgets, particularly how it's done kind of year to date. Are the sales staying up the way they were last year? Are they increasing? Are they decreasing? What are your budgets, profit and loss, statement of financial position, cash flow, maybe particularly, for the next 3 years. What's the state of your IT? Is it up to date? Does it work well? Does it work reliably? Is there much downtime? Have you been attacked by viruses and hackers? Have you had any release of personal information through hacking, where there might be some liabilities still kind of lying around if people suffer financial loss? What about the people you employ? Talented research and developers, talented salespeople. Quite often these people get nervous if there's a takeover and they go and find another job. And if they're on a kind of contract that allows them to leave within a month, and particularly if you're taking over a service industry, and in the service industry the non-current assets are relatively small, the real assets are the people, but of course the people can leave and transfer their talents to a rival. So the really key people, you would be interested in seeing, are they locked in for 6 months? Or might they be willing to be locked in for 6 months when I take them over? We might even begin opening negotiations with individuals at some point to try and retain their services. What regulations is the company operating under, and has it been good at complying with those, or is there some hangover from some breach of regulations in terms of fines, damages, maybe loss of license? What's the environment we're in, say the economic environment? What's the competitive environment we're in? What's the environment with regard to whether or not the product and the products being sold by this company seem to be still popular? Or are they kind of yesterday's products, and we're going to be hitting the kind of decline phase of them? What are our major contracts? Who are they with? How long do they last for? How are they going? Are they expected to make a loss? Or are they keeping the costs down? We see a nice juicy profit coming in, because what of course the acquiring company is acquiring is the future profits, not the past profits, or the future losses. Look at the accident book. Has anyone been seriously injured recently, where again there may be bad publicity still to come, or there may be fines and damages to have to pay to that person. Board minutes will definitely be looked at to see major thoughts of the board, maybe why they're selling, maybe what they think of your offer. They should be discussing major problems, maybe with a development of a new product. And of course they'll be also talking about major good things, like that they've won a major contract is almost certainly going to be noted in the board minutes. We'd be interested in new product development. How far along the development cycle are, and when can we expect this to begin earning revenue? So if we have what looks like a real winner of a product almost ready to be launched, then of course that's going to put the price up. But if you look at the development cupboard and it's bare, there's nothing being developed, and the existing products are a bit old, then not great. And that we'd be thinking maybe this is the wrong company for us to be investing in. Major customers, what's our relationship with them? How long have they been with us? Major suppliers, are they monopoly suppliers? Are they reliable? Can we turn to other suppliers if we don't get on with these people so well? Are they flexible and the like? Does there seem to be a good relationship with both suppliers and customers? We could put in here also, it's not on the list, we could put in here employee relations. Do we have a fairly contented workforce, well motivated, who tend not to go on strike? Who are the major competitors? What are their plans? Do they seem to be streaking ahead of us, or are we doing ahead of them, and so on? There is a multitude of stuff that we would like to find out before we decide how much to pay for a company, if indeed we still want to pay good money for the company after we've found out this information, which is going to impinge very heavily on a their future success. What we need to, some of the difficulties we're going to be having in here, or some of the things we have to get straight before we say yes. Of course, there's always the possibility of the ethics getting in the way. It will be the buying company that pays us for this report, and if they are already an audit client, we have to watch the fees and so on. We have to watch competence. We have to watch advocacy, and if you look down here, we've got here that the takeover is a client's decision. We are not going to advise the client, take over this company, it looks good. What we're going to be doing is giving negative assurance, saying we don't find anything particularly alarming in the company that leads us to believe that, it's going to get into financial difficulties, or its sales are going to fall, or, the profits are going to fall, or something of that type. But you are never going to be saying, take it over, because that's really entering into the management of your client company. It's for the directors to decide on the strategy of the company. So you need to look at the time scale if we're approached. Very often, these need to be done very quickly. You've approached a client and you want to get the deal done maybe before other people find out that you're trying to buy that company, because they might put in a counter offer, and so the price begins to go up and so on. So usually there's a need for considerable confidentiality and for speed. And again, it can interfere with your current workload. Do you have enough people with the right experience? This tends to be done with people a bit higher up in the amount of experience and talents they have. It's not a job for really people in the first year. We have to make sure from our client that they will arrange cooperation from the target company's management. This kind of presupposes, of course, it's going to be a friendly takeover, not one which is disputed. We need to know the extent of the work. We need to tell our client that most of the work is going to be done through analytical review and inquiry of management. You simply don't have the time in most cases to go through everything, with a fine-tooth comb. You'll ask for lots of information, lots of photocopies and so on, but it's still going to be a bit of a rush job, usually. You'll also state that because of the nature of it, you are not their auditor. You're going in there to get a quick look. You'll also want to state that there's a very high chance, or a chance at any rate, that misstatements, irregularities, fraud that are within the target company may not be found. There's a lower chance of them being found on this due diligence report than there would be if you were the formal auditor. And finally, there's the fee, of course. How much will this rush work be worth? And it's often worth quite a lot, because the client wants it done quickly. The client knows this is a really good business opportunity, and is often prepared to pay, if you like, much more than, so to speak, they would for the audit. They find often the audit is a bit of a necessary evil, whereas a due diligence report, it's quite exciting if you think you're taking over a company to bring them into your group.